questions, just put it on the chat window so that I'll address that. Now, before starting with this, can I know like what is your trading experience so far, and is there any difficulty which you're facing? So can I start with yeah, Anurag? So you're trading in Anurag. Just one more thing, in the chat window, can you send it to everyone instead of sending it to me privately? Alright. So you are trading in FNO segments, okay? And what kind of strategies have you been doing till now? Alright, so you take a directional position based on the moving average crossover. Okay, alright. So you take directional position you just using futures or with options as well? Okay, alright. You use options to hedge yourselves. Okay, that's good. And have you used any tools till now to back test your strategy, or is it more based on the gut feelings? So I'm asking that the strategy which you have, is it more of a systematic mode, that is you have strict entry exit rules, or is it more like that you okay, all right, great. And you said you wanted to know more about how you can improve on the automated trading part. So right now I think your rules generation, or the rules which you are having, that are getting generated systematic, and now you want to automate your strategies. Okay, all right, thanks. uh, Vijay, can you just let us know like what type of strategies which you have done till now, or what do you want to learn to make your career, or what exactly are you looking for? Alright, so you also have the same strategies. You have done the backtesting, it's systematic, and alright. So you're working as a risk analyst, and you want to shift to automated trading. Alright, so first what I'll do is I'll break down these terms: quantitative trading, algorithmic trading, and high frequency trading, and then we will look into each aspect of it, that what does it cover. Right, let me just write what are we going to cover. So we have three terms: quantitative trading, automated trading, and high frequency trading. Alright, so far whatever trading strategies that normally people have been using is more of either fundamental based or technical based. Alright, so in fundamentals, you are mostly trying to look at the balance sheet of the companies and trying to see what will be the future of this company. And alright, we'll cover it, that how can you automate and how can you backtest and make new strategies. So first, let's be clear of these three terms. Yeah, Anurag, what is it? I think it is possible. I mean, I'm not aware of how can you automate your strategies on ME broker, but I think I have seen some of the people who have done it. I guess now ME broker itself is providing some of the modules where automating the strategy is possible. But again, these platforms where you are using the inbuilt tools, they kind of restrict yourself in still automating the strategy. Right, so I'll just explain that, how does it restrict yourself in coding that strategy. Alright, so we are going through this three terms: quantitative, automated, and high frequency trading. I explained what is fundamental trading, and then there is a technical trading where in technical trading people use the previous price patterns to forecast what will be the future returns. Now this third type of trading, that is quantitative trading, that is totally based on the statistical analysis of the data. Alright, many times people think that what is the difference between a technical trading and quantitative trading when both are relying on the historical data. Alright, so the first difference is that between quantitative and technical trading is that most of the time I have seen technical traders, they work on only the price movements. Alright, but there are many other factors apart from the price movement which are observed in the market. For example, volume is there when there is open interest. There is a relationship between the futures options and the cash of the same underlying. There is a relationship between the same sector stocks. So this type of things are many times not looked at by the technical traders. Alright, so technical trading and quantitative trading both are based on the historical analysis, but quantitative trading will be using the statistical analysis methods. Alright, okay, Sumit has joined in. Sumit, are you able to listen to me? Okay, alright. So quantitative trading started with actually it started with risk management, where investment bank had to hedge their risk, or they had to come out with the pricing of some exotic products, and based on their pricing, so pricing always depends on how one can hedge that particular product. Alright, so if the hedging cost is less than what you can sell that product for, then there is a pure arbitrage position which is possible, and you can make a profit using that position. Alright, so it started with that pure arbitrage where people tried to come up with the formulas to explain or to come out with the hedging strategy for exotic options or exotic products, you can say. Alright, and they tried experimenting or they tried with how can they profit by hedging themselves completely and not taking any risk. Alright. For example, a pure trading arbitrage you will be between different cash segment of different exchanges. For example, BSE and NSE. You trade into the same stocks, right? Where you are buying at a lower price in one exchange, selling in another exchange. That is a pure arbitrage strategies. Now the thing is this: pure arbitrage strategies have been losing their profitability, or there are very few opportunities in this space, is because many players are coming into it. So the next way to trade is you need to learn to take some kind of risk. You need to learn to take some kind of risk, right? Now, as a trader, you need to find out first that what kind of risk are you comfortable with. So, for example, when Anurag and Vijay, you said that you are trading the directional view, alright? So you are comfortable with taking the directional kind of risk. Apart from that, there are risks. For example, when you are trading options, there is a delta risk, gamma, vega that you can take. If you are doing statistical arbitrage, then there is a risk of you're betting on the spread between the two securities, right? But to make this kind of strategies, one need to be aware of the statistical concepts using which they can analyze the data. After the analysis, they need to combine that data together to make a view, and then they need to backtest that view. Alright, so trading steps. Let me first Alright, I'll answer that question, Anurag, in just a while. Alright, so trading strategy steps are very simple. You first is to gather the data, right? After you gather the data, study the characteristics of the data. Now here you may require statistical concepts. It could be very simple statistical concepts like understanding what is the standard deviation, what is the correlation with other market observations, alright, and alright, we'll come to that as well. Anurag, best data vendors in India. The next, when you are studying this characteristics of the data, after you study the characteristics, you make a view. You make an assumption about the trading. So after studying the data, you may see certain patterns, or you may see certain co-movement in the data. So based on that, you may have a trading idea. So you need to come out with a trading idea. Alright, once you come out with the trading idea, the next thing is you need to start backtesting it. Alright, once you are backtesting, now this fourth, and there may be certain parameters which you need to keep on optimizing. Alright, so fourth and the fifth are recurrent steps where you do the backtesting. After you do the backtesting, there will be certain parameters which you need to keep on changing and again do the backtesting. So basically you need to keep on refining your trading assumption or trading idea till it gives you the maximum profit. Right? And the last part of the trading strategy would be, once you are finalized with the strategy, you need to implement the strategy. Alright, so this is the trading steps. Out of these trading steps, the first 6 steps, first 5 steps This falls under quantitative trading, alright. And the last part, that is the implementation part, that falls under algorithmic trading. Yeah, you can summarize like that as well, Anurag. You gather the data, you discover the pattern. The discovery of the pattern in a quantitative way, you do it through statistical test, and then you make a trading idea. You backtest that trading idea. Along with the backtesting, you will keep on optimizing it, and then you may do forward testing in terms of actually that forward testing is not clear to me. What is, are you talking about the paper trading? Yeah, so you can do paper trading as well, or you can do out of the sample testing as well, right? And the last step is the implementation, that is algorithmic trading part. That is automating. So this is algorithmic trading or automated trading, right? I'll come to it what's out of the sample as well. Right. So the first 5 steps are quantitative trading. The last part, as I said, it's automated trading. That is, you make a computer program of your strategy so that that program will keep on monitoring the situation automatically. It will keep on doing the calculations which you require. And whenever there is a trading entry rule which gets triggered, it will send the orders automatically, and it will do the position management, risk management, everything. I'm not aware what is AFL. Sumit, I'm not sure. Are you able to send like orders through any broker? No, no. So this implementation, when I'm saying, that means, yeah, it contains to do the real-time calculation. Along with that, it will also send the orders automatically depending on what parameters you have set in. For example, you say that whenever your trading signal is getting generated and you want to buy say 3 lots or 5 lots, again that 3 lots or 5 lots could be executed using different types of strategy. Alright. So first, I'll show you an example of what is automated trading as well. So first, let me get into this quantitative trading. Alright. And I'll show you that what type of tools can be used to do quantitative trading or quantitative analysis, you can say. Right. So first step, which was to gather the data. Now, Anurag asked that like what are the good sources to get the data. It depends on what kind of data are you looking for. Can you tell me like what is the kind of history and what kind of data, that is cash or FNO, do you use? You want tick by tick, NSE, FNO. Okay. So what do you mean by tick by tick? Okay. Uh, there are uh, there are data vendors. The most you know well-known data source is this. I forgot that name. Just a second. It was MarketView Terminal or MarketView, that is by Ticker Plant. There is a software Ticker Plant that is. Let me just show you its website. Alright, so this is a software that is there for Indian markets. Alright, so its cost is somewhere around 5 to 7,000 per month, depending on what kind of exchanges are you subscribing and what type of segments are you subscribing it for. And it will have the 1 minute data or the 1 second data as well. I guess you are calling that 1 second data as tick by tick data. Alright. Actually, that term is very much misused by people. I'll explain what is tick by tick data when we go for high frequency trading explanation as well. Right, Vijay, I'll show it. So first, how to get the data? I'm using data from Google Finance. I'm sure you might have gone through what is a Google Finance. MCX data in where? Google Finance, we don't get it. But in Ticker Plant, if you're subscribing for any paid software, then this Ticker Plant provides the MCX as well, even the NFC currencies as well. Ticker Plant data can be exported to CSV files. So you can export it to Excel or CSV files and then use it. Right. So if you are looking for free source of data, so there is Google Finance and Yahoo Finance which is available, but they will provide you. Okay, I'm getting questions from everyone. Everyone, just please do one thing in the chat window, send it to everyone. In the send to drop down, make sure you are sending it to everyone so that everyone knows what's your question. Right, so Vijay was asking me earlier, can Ticker Plant data be exported? So as I said, it can be exported. Asim is asking, is there an API for direct feed? There is an API which Ticker Plant provides. It's actually not an API, but you can get live updates into Excel files as well. Alright, so I'll not call it a direct feed because it's very difficult to use that data from Excel. Alright, I'll come to the API and everything when we go for automated trading. Right, so just bear with me for another 15 minutes and we'll go to automated trading. So as I was saying that Google Finance and all this source of data, from this we can get intraday data, but only for cash segment. Right, so if you are interested in how to get data from Google Finance, right, so for that I have written one article on how to get this data from Google Finance. Right, it's a very simple R script. Okay, so all the code and explanation is given over here. Right, so just go through this link if you feel that you want to download intraday data from Google Finance. For my trading strategies, I use cash data only, uh, and the options data is available from interactive brokers for uh, active maturities. Right, so that serves the purpose for me. Now that code which I showed you was in R. So let me just open R and show it to you that what is R. Alright, so the first step, that is gathering the data, is done. The next, as you were asking, as Vijay was asking, how to analyze this data. Right, so for the analysis purpose, it could be as simple as can be done in Excel as well, or it can be a specialized statistical analysis software. Now this is an R software. It's very much similar to MATLAB, who have worked on MATLAB, and it allows you to do all the statistical tests and all the functions which MATLAB has. But the best part is it is free and open source, and there are tons of libraries which is available to do statistical analysis. Right, and if you want, that link is also given in that over here. I think I have provided our link as well. If not, you can just search for download R. Right, and this is the link from which you can download R. I'll come back. Okay, I'll come to the stats book. So let me just explain that how does this R work. The thing is, when you are looking for something on any topic, there are tons of books which are available in the market. But all these books are, it's good to understand the theoretical concept, but there are very hardly any book which tells you how to apply it on a practical level. For example, you will find all the books related to many books related to pair trading. Right, so this is one of the strategy that I teach it in the course. Right, so this is the R code for that. It's a very long code. Right, and this does the analysis and then doing the backtesting and everything. Right, it generates all the charts which are required by me to look at. There is the spread between the two instruments and everything. Right, and it gives me the backtesting result as well. The problem with finding a book is that you will get the you'll understand the concepts, but then it will be up to you to decide how to apply those concepts for a trading strategy. Right, so if on one topic I can give you many books, and all of them would be very good at explaining the concepts, but it becomes difficult once you know all the concepts to understand how to put it in a practice. Right. So pair trading is same sector, that is all the sectors which move together. All right. And this is the example of that pair trading exercise. All right. So totally from 20th April 2012 till now. Sorry, it's still April only. So around 1 month of the trading, it's giving like 23 signals, and total profit is coming out to be 1,94,000. So this is known as statistical analysis. So here I'm observing the standard deviation, calculating the spread, calculating the z-scores. All right, and once I'm convinced that this is a potential pair for me to trade, the next thing I need to do is the backtesting. All right. And so in backtesting, what you see is how can you improve. So once you have a trading idea, you need to decide when to trade. For example, if these are the spreads which has been in the past, right, you need to find out at which spread will you be short and which spread will you be long. Then you need to try to time the market. So you need to understand that your holding period for the trade should be as minimum as possible. Alright, so you should try to time the market properly so that not only you are in profit, but your profit is coming at the appropriate time. Right, and this is example of just one pair. Then when you have multiple pairs, then you need to decide how much fund allocation you need to do for each pair. Right, so for that you need to understand again the correlation between different pairs. You need to understand the profit and loss volatility of each pair. Right, so these are some of the ideas which can be used to maximize your profit. See, ultimately trading is nothing but taking the minimum risk and generating the maximum returns. Right, so so this is how back testing can be done, and the trading strategy can be uh, automated. Right, this is still the signal generation part. Right, so we have come about this, that is how to do the back testing and how to use this software. The next thing, as I said, was optimizing. So as I said that by looking at the data, you need to decide how to enter into the market. For example, when over here, when you feel that now the spread has started in mean diverting direction, that is the time that you will start entering into the market. Right, so there are very small fine-tuning things which you can do with the trading strategies, which can help you to generate profit enormous. I mean, it will change the profit equation drastically. Right, so for example, over here in the first chart, when I'm looking at that, the standard deviation of both the stocks should be the same. Right, so that is required. So you need to find out. Right, so when you are doing the trading strategy, you also need to understand that when is that trading strategy working and when it is not working. For example, is this the case when the volatility is higher in one stock and lower in another? Is that the time the strategy is performing better, or when they are at the similar level, that is the time it is performing better? Right, so this type of microscopic analysis that needs to be done at the trading strategy level if you want to do it professionally, because here you will not be trading just one pair, you will be trading lot many pairs, and to optimize at every level is required. right? Is there any? Yes, optimization of leverage also falls into this. For example, how much capital allocation you need to do at for every pair, or how much leverage you should be using for every trading strategy so that you don't run out of money. That is also something that comes under quantitative trading, right? Does that answer your question? Right. So for this pair trading, like I'm using a concept of co-integration. Right. Many people use correlation as a tool to make good pairs, but take my words that correlation is not the parameter on which you should be doing the pair trading. Right. So for this, you need to understand the statistics. That is why correlation is not better, or it's not a good idea to use correlation for pair trading. Unless you know how the mathematics work behind the correlation, you will not be, uh, you know, able to use the right tool to make a strategy. Alright, so that covers the quantitative trading part. And in this quantitative trading, what can be done is, once you have this type of R code, you can keep on running this R code on the most updated data set every minute or every 5 minutes, and it will keep on generating the signals for you. Like whenever it gives you signal, it prints out this line. Right, so R can be used till the automation where it is generating the signals, like any broker. Right, so if you are planning to do a semi-automatic system where the signal generation is automatic, just the execution part is manual, then I call it as a semi-automatic system. Then working with just R and Excel will do it for you. Right, or it could be any other language, like MATLAB can also be used. The advantage in using this type of they will come to that, how to automate it. The advantage of using this type of script, that is R or MATLAB, is that there are a lot of customization which can be done when you are doing the backtesting part. Yeah, R is a open source free software, right? So that is the, I mean, I don't like to bind myself with the constraint of the software. Right. So now, and there was one more question, Anurag, you asked me, was what is out of sample testing and what is in sample testing? Right. So when you are doing the back testing, see what happens. I'll give a very quick example. Say when you have say you have 10 data points, where say you have 10 prices with you. Assume in this pair trading strategy, I'm taking it on a dollar neutral basis. Right. So coming back to in sample and out of sample, for example, you have this 10 data points. Right. You use the first 5 data points to calculate your strategy parameters. For example, if you are doing moving average crossover, all right, so you use the first 5 data points to come out with the moving averages, and based on that result you apply it for the 6th data point. So the point is, whenever you are doing the back testing, whatever, I mean, you should be using the data which is available you till that point of time, do your calculations, and then use that calculation to apply it to the future data point. That is known as out of sample. Many times what happens is that people do in-sample testing, as they'll calculate or do the optimization or the backtesting using this 10 data points, and then they'll test it on this 10 data points itself. That is the time you may have heard of too much of optimization or too much of curve fitting, right? So that happens when you are doing it in a wrong way. Alright, so now let's go to the last step of the trading strategy, that is algorithmic or automated trading. Now for the automated trading, first of all you need a platform using which you are able to connect to the exchange. Alright, so for example, I'm using Interactive Brokers. Now this is the software of Interactive Brokers, right? It's a demo account. And secondly, you should know, it should provide an API, that is, it should allow our high-level program to interact with the exchange. That is, it acts kind of as a bridge between our program and the exchange. Alright. So for example, this is a C++ program. It's a very simple program which I have written. Right. Let me just run this program. Right. So it's a very simple program. It first it connects to this Interactive Broker. So when I click on connect, it asks for the permission that should I allow this connection or not. Right. Sorry. And next, I have just two buttons, that is start and stop. What I have done is it's a very simple program where it will keep on sending orders into this script Apple and Google at a frequent interval. For example, at every 5 seconds it will keep on sending orders at Apple, and at every 15 seconds it will keep on sending the orders for Google, and the orders would be placed at a mid price. That is, whatever is the current bid ask going on, it will just place the order at a mid price. Okay, so let me just show this. Just a second. This demo system actually sometimes keeps on hanging where the prices don't update. Let me just stop and try to connect again. Order at mid price, that is the average of bid and ask. It's still not getting updated. Okay, let me just start the software again. If you want to do paper trading as well on Interactive Brokers, then let me know. I can provide you guys with the demo account, with a paper trading account. So basically, C++ program interacts with interactive brokers, where it will keep on getting the updated prices, right? And yeah, IB requires minimum $2,000 to trade, and brokerage is still kind of on a higher side compared to other brokers. So it depends on the trading frequency of yourself. So if you are doing kind of intraday trading, then interactive brokers may not be for you. In that case, there are other platforms which are available. There is one provided by NSC itself. So there is a software Symphony which is provided by many brokers. That is Sher Khan is providing. I guess Zerodha is also providing. No, no. So there is company Symphony. That uh, software is Presto, and they do allow. It's a Java-based software, and they provide an API as well. Yeah, Symphony charges 7,500 per month. That's correct. Right, so let me just show this. Right, so here this program, it keeps on sending the orders of size 5 at a frequent interval. Right, I guess it's 10 seconds for Apple and sorry, 5 seconds and 15 seconds. Symphony is offered by Sher Khan. If you want, you can directly contact Symphony and they'll give you the list of brokers. I3, I'm not aware of I3 actually, maybe only for algo execution. Right, so basically this is the kind of software which you'll be writing. That is a C++ program which will keep on monitoring your situation, and whenever it senses that your trading signal has generated an entry trade, then it will send the order automatically. When I say assume mid price, that means orders. For example, here the Google is 835.8 to 836. So my order would be placed as a limit order at a price of 835.9 if I'm buying. So I'll become the best bid in this case. Alright, so the point is over here that there are many platforms which are available, but problem comes when you need to code it. Now here there are many risk management criteria that one needs to take care of when they are making an automated trading system. For example, say if you are doing intraday trading and you are building an automated system, first of all, if you are placing the market orders every time, you are losing on the bid-ask spread every time. That is, you'll always pay bid-ask spread. And if you are even doing like 20 or 30 trades in a day, that will eat out of your profit. So how can automated trading system can help you is that you can try to earn the bid-ask by yourself. That is, whenever you want to buy, you will keep on bidding your quantity, along with the best bid price. So that will, what it will do is, you will be always at the best bid. So whenever someone is selling you, you will be the first person to get the fill. So in that case, you will be receiving the bid ask spread, and especially if you are doing in futures where for example the lot size is 4,000 and even there is a bid ask, I mean tick size itself is 5 paise. Alright, so if you are paying bid and ask when you are taking a position and when unwinding your position, so essentially you are giving like 200 rupees every time. Alright, so your 400 rupees profit is gone in just taking the position and unwinding your position. Right, but if you have this kind of automated system, then what you can do is whenever you are planning to take a position, you will keep on sending the orders at the best bid price for certain amount of time, and then if that within that time your order is not getting filled up, then you put the market order. You can split that order as well. So the point is, it's up to you. I mean, it's up to your imagination and the idea. How can you do the execution part? And when you are doing this automated system, there are many checks that needs to be done, that your system does not go into the self-destruction mode where it keeps on sending too many orders. How to do the risk management at a portfolio level, how to make sure that your portfolio is squared off automatically when you are so for all this, Vijay, you will need to learn C++, either C++ or Java, depending on which platform are you using. If you are using interactive brokers, you can do it in C++. If you are using Symfony Presto, you need to do it in Java. Of course, you will need to learn the concept first, and it may take time. If you are not from programming background, then it may take time, but programming is something which can be taught or it can be learned. Alright, so this was the automated trading part. Here there are many checks you need to put in, like there are certain limits put by the exchange that how many orders can be sent in 1 second. You should make sure that you are not violating that limit. So Asim, again, it depends on your strategy. For example, if you want to wait for 5 seconds or if you want to wait for 10 seconds, depending on how liquid is the instrument. Right, sometimes waiting may give you a favorable price as well. For example, if you are buying and say the prices are going down, and if you are moving with the best bid price, it may so happen that so your strategy could be you keep on waiting till you are getting the favorable price. If the price starts going upwards, then you can say you immediately put the market order. Right? So that kind of logic can also be built into this. But again, I mean, you require a good amount of programming knowledge to do this. Right? In the course, we'll be going through the basic part in the sense how to get the basic strategy working. Right? So we'll be going through from the scratch how to do it in C++. Right? So that was algorithmic trading or automated trading. Right? Any questions so far into these two topics, that is quantitative trading and algorithmic trading? And the next is high frequency trading. Alright, so this is the last one which I'm going to explain. Now, Anurag, I guess you told me that you want to use the tick by tick data, right? So first, let's understand. You're right, Vijay. So you backtest or I backtest using R and then do the coding in C++. It's not time consuming if you know the programming. Anyway, trading strategies are not something like it takes time to build up a strategy. It's not like you can make a strategy overnight. It takes at least 2-3 months first of all to come up and do the analysis part and come up with a good trading idea. Then again, it will take around 1 month. If we are willing to see, ultimately if you want to do this type of trading, then you need to learn this. There is no shortcut way of doing things. Alright, so let me just get back to high frequency trading and then I'll take some more questions if there are any. So normally whenever you are getting the okay, let me just finish up with this high frequency trading with it, then I'll answer your question. Right, so whenever you are trading some system, you would see that you are getting updates at every second. All right, you may get update at every second. So in that update, you get what is the uh, bid quantity, what is the bid price, what is the ask price, and what is the ask quantity. All right. So actually, what we are getting in that data is the snapshot updates. Now, what happens is that exchange keeps on getting the orders from the traders at any time. Okay, so it may be so happening that between second 1 and second 2, there are like 100 orders which are coming to exchange. And in this kind of a snapshot data, what exchange does is at every second, whatever is the order book snapshot, it gives you that best the first level of that order book as an update. Alright, but that is not tick by tick data. I'm hoping that everyone is knowing how the order book is updated. Right, so for example, let me just quickly take an example of order book. So this is the order book. I'll just make two levels of it. So there is 10 quantity at a price of 100. There is 100.2 at a 15 quantity. Again, 20 quantities as say 99.5, and say 100.5. You have more 25 quantities. Alright. Say now there is one more new order which comes in, and it comes in at a price of 100.1. So at a time of 1.1 second, there is an order of buy 5 at a price of 100.1. Alright, so what will happen is this order book will come down and your bid will become 5 at a price of 100.1. Alright, say in the next second, next 1.15 second, this order gets modified to 100.3. Right, so this will become 100.3. Right, so next 1.25 second, there comes a buy order. So buy 5 quantity at a price of 100.3. Alright, so in that case, out of this 15, 5 would get executed, so this ask quantity would become 10. So the point is, there would be many updates which are coming to the exchange within that 1 second. But in a normal broadcast data, you just get what is the status of this first level order book, or the first file level of the order book at every second. Alright. And in a high frequency trading data, instead of just every second update, whenever the updates are coming from the traders, or whenever there are so you'll be getting updates at every 1.1 second, 1.15 second, 1.25 seconds, and so on. Right, so that is high frequency data, or that is actual tick by tick data. Right. The thing is that there is a lot of infrastructure cost which goes behind high frequency trading. Minimum startup capital that will be required just to set up the infrastructure would be somewhere around 30 to 35 lakhs. Right, and then you will require the capital to trade somewhere around 1 to 2 crores. Right, so at a retail level, it kind of becomes difficult to do this HFT trading. So infrastructure, I mean that you will require a lease line, you will need data connection. So NSE provides different types of data connection. The one which I mentioned was a broadcast data. For high frequency data, again there are two types of lines depending on how many orders can be sent per second. Right, then there is server cost, there is co-location cost, there is software cost, everything. For the non-HFT trading, capital is decided by you. So non-HFT trading is the trading which you are doing currently. Right, if you are doing it on options, you can do it with 50,000 as well. Alright, so non-HFT is any strategy which can work on 1 second data as well. Right, so there is no capital constraint on that. The only thing is you require the cost of software, that is your infrastructure cost. For example, Interactive Brokers or Symphony, that is your cost. Alright, so this was high frequency trading. In the course, I teach that how can you analyze high frequency data. Alright, so there are 3 or 4 lectures in which I say in which we go through how to analyze this high frequency data, because this high frequency data comes at a microsecond level. Alright, and it has much more information than the broadcast data. Right, but the thing is, I cannot show you practically how that HFT is seen into the software, because it requires a lot of infrastructure cost. But if you find a broker who is willing to spend after the infrastructure, or who already has the infrastructure and allows you to run your strategy, then you just require the either you should make your own program, or there are ready-made programs which allow you to code your strategy, and you need to buy those softwares. Right, so this was high frequency trading. Right, now coming back to your question, Vijay, where you asked how much time does it take to go through or to learn all this. I'll say that it depends on how much effort are you putting after it. It differs from person to person, and its grasping power, how fast they can learn. right? So I mean, I cannot put a time frame for you where I'll say that you give me this much amount of time, and R is very easy. R is very easy. C++ is the part, or the high level programming language is the part that kind of becomes difficult. R is super easy. It's very friendly as well as compared to MATLAB. So even if you want to do semi-automatic, I'll say semi-automatic system can be done very easily. That is using R, and it can be learned in 2-3 months for sure. Even if you are not done programming anytime. So say an MBA with high school computers and self-learned computers guy will take on. As I said, for R, 3 months are sufficient. For the C++, you need to put in extra effort. It may range anything between 3 to 6 months. Right? Is there any other question which I can take? Oh, sorry. Sure. So let's quickly go through what are the different types of trading strategies. Alright, so the first one is the normal trend following systems, or the momentum based trading. Alright, so it's simple. I guess everyone has done some kind of trend following or momentum where you are trying to forecast what will be the direction. The next is mean reverting strategies. Alright, these are many times called as market neutral strategies as well. Right, so this is same as the pair trading or the long short and everything, where you are trying to take a view on the spread between the two instruments. Alright, the third type of strategies are contrarian strategies. So contrarian strategies, they believe that whenever the market is going up, it will be either overbought, or when it is going down, it will be oversold. So if the market is going up, they'll keep on selling it. When it is going down, they'll keep on buying it. So those are contrarian strategies, right? Then there are option strategies. So within option strategies, there is delta neutral or gamma scalping. Both are the same thing. Or there is volatility arbitrage. Again, this is a statistical arbitrage, or it's not a pure arbitrage. And the fifth type of strategies are market making strategies, right? So in market making, your view is to earn the bid ask spread. It's mostly will be done using options. That is, you keep on offering your bid and ask, and you'll keep on hedging your portfolio for any type of risk. And the last type of trading strategies are incentive based strategies. So exchanges many times come up with the incentive schemes. For example, if you do the market making for in certain instrument, they give you the daily incentive, right? In India, it's mostly done by BSC. So if you just search for BSC leaps, nowadays it's there in MCX SX as well, but there's hardly any liquidity in MCX SX. There are very few market makers or the people doing this incentive-based scheme in MCX SX. I know there are many people doing it in BSC. For example, they have this many programs going on, so they have incentive for options on mostly indices and futures and options of liquid scripts. Right. So if you are making markets on index options, that is 7 strikes and 2 options, that is call and put. So total of 14. If you do it in all the 14, you may earn up to like 3 lakhs per day from the exchange. Right. And then there are extension of this strategies as well. For example, for market neutral, there is an extension of index arbitrage or basket trading as well. So in index arbitrage, basically you are trading index versus some of the constituents. In basket trading, it's one security versus one or more security. So basket trading is again kind of pair trading, but with more than 2 script. Right. So any trading strategy would be following in this categories. The point is that how can you be profitable into the market is when you are looking or analyzing the data in a more different way than any other person trading the market is looking at. For example, when you look at how can you combine or how can you see when, for example, when the volumes are picking up, when the open interest is picking up, how is it affecting the prices? Or you look at how the open interest was built up and then forecast the next medium term price movement. Intersector analysis, it's very difficult to do because I don't prefer doing long short of intersector analysis. For example, it does not make sense. It does not make sense for me to long one stock of one sector and short another. This may work as a medium term frequency trading where you are taking a view on the sector. So when you are saying that one sector would outperform than the other sector. Right. So when you have a view that say pharma will outperform utilities or IT will outperform all the broader index. Okay. At that time you can do intersector analysis. But again, intersector analysis is something which is more on the fundamental side. Just looking at the price movement, it becomes very difficult to do medium term of prediction. When I say medium, that means next 4 to 6 months. Right, because this long prediction, it becomes really difficult. There are methods to do it where you look at how the trading pattern has been changing, how much FII is putting money into particular stock or the particular sector, and then you can look at the time series and do that analysis. But again, it will be more also based on the fundamental analysis. So quantitative trading is anything which has numbers. Just a second. તમે નીકળી જાય. Sorry. So quantitative trading, whatever you can represent it in number and you do the analysis is quantitative trading. So basically, whenever you are doing a strategy, you should know that in what type of market scenarios does it work better. Does it work better when there is low volume? Does it work better when there is high volume? Does it work better when there is low volatility? There is no one into the market, or does it work better when there is a lot of movement into the market? Right. So any observable parameter when you use in your trading strategy, that is, so quantitative is the term when you are turning the numbers. Right. So even I will say some of the technical trading you can put it as a quantitative trading. If exactly no charts, no patterns, no gut feeling based trading, anything which has a systematic rules, I classify it as a quantitative trading. I don't mind if even if you are using some technical indicators, I'll just say that whenever you are doing some trading, there should be certain rationale behind that. That is why you think using those signals should work. Right? Then it makes sense doing the trading. You should not just look for the trading indicators which you just take 1,000 indicators and see which one is working. Right? That is not the way to start. You start with a rationale, that is what kind of market conditions you are trying to get benefit from. Then design your indicators which works in those market conditions, or which tells you when those market condition is arriving, and then do the backtesting. Right? To answer Asim's question, so market making is mostly on options. Yes, mostly market making is on options. Futures, I mean, people don't do market making. Basically, market making would be done where you are able to hedge your risk. So if you are doing it in futures, it will be just taking the reverse position in cash. Probably you can do it if there is a lot of volume and at the end of the day you are not carrying any positions. Otherwise, market making in futures would cost you a lot. Alright, is there any other question? I mean, I know it's very difficult to get everything in just 1 or 1.5 hours. I hope, but I have given you certain ideas that what goes into quantitative and algorithmic trading. Is there any other question which you guys want me to focus or answer? I mean, I just go through some of the questions which I frequently come across. That is, so this was the API. I think that's what I showed, right? This was the API of interactive brokers. So API is nothing but a piece of code. There are certain questions which I many times come across when someone asks me about quantitative trading. The first question they ask me is, you know, what kind of returns can you generate using quantitative trading? All right. So I tell them that it depends on what kind of strategy do you build. Many people are just looking for ready-made stuff that is, where they just need to put in money, right? And they expect that it's kind of a money machine and it will keep on giving you profits. But every time you come across this kind of money making machines, just think of this, that if someone has a holy grail of trading strategy, that is a money making machine, why would someone give it to you, right? So here in the course, rather than giving you the strategies, I try to explain that how can you make your trading strategy better, or what are the things that you can focus on that can help you to make your strategy better. Yes, again, trade management is important. Allocation of the fund is also important. Right? This sort of things, is very easily bypassed by a retail trader. And if you want to succeed, systematic way is the only way to earn profits. And again, it's not like once you make a strategy that will work for you for lifetime. You need to keep on continuously modify it. You need to keep on working on optimizing, because the market conditions will keep on changing. So you need to uh, adjust your strategy according to that. For example, one pair will not work for lifetime. So you need to find out when that pair is working and when it stops working. Right? So this sort of things it's a continuous process. Right? Is there anything else which you guys do? Alright, so let me tell you guys about my background. I have done IT engineering from Mumbai. Then I was working with Edelweiss, and after working for almost 1.5 years with Edelweiss, I went for masters in financial engineering from University of Michigan. Right, so I completed my masters, came back to India. I was working with Morgan Stanley for more than 2 years. After that, I joined a prop desk where I was working on high frequency trading systems. I was trading high frequency systems. I was doing options market making. I worked there for around 10 months, and then I left it last year and started trading for my personal account since this January. Right, I'm mostly trading pair trading and option strategy, mostly on the volatility arbitrage, and then again I started teaching this course since March. So on weekdays I'm trading for myself. I'm also consulting some of the brokers who want to set up algo trading desk. Right, there's one more strategy which I have given to a broker. Okay, so he's running there, and I given the resources and everything. So in weekdays I do this consulting stuff, and on weekdays I'm teaching this course. Okay, does that answer your question? Alright, thanks everyone for attending this. And if you guys have any other question, feel free to call me or drop me an email, and I would surely try to solve your queries. So even though anything related to quant you want to know, so just drop me an email or call me up. Alright. Alright guys, thanks a lot for your time.